Some stocks are so good, the underlying business is so consistent and so valuable that you'll want to put a ring on it and hold it forever. These stocks are called forever stocks. And in this video, we're going to be going over Visa and why it may have the makings of a forever stock. I want to go ahead and welcome you to the Fiscal Philosophy YouTube channel. I consider myself to be a value investor. Now, there's a cliche that goes, price is what you pay, value is what you get. The forever stocks, as I call them, the focus is more on the second half of that statement. It's the what you get. There's a fun story about how Warren Buffett invested in Coca-Cola in the 1980s and made pretty solid returns in the low double digits on that for about 40 years. When he bought it, the PE was something close to 30. And that just goes to show that on a long enough timeline, when investing in high quality businesses, almost any entry point within reason can appear to have been strategic. And so we're going to take a look at Visa today and see if perhaps this can do for you what Coca-Cola did for Warren Buffett back in the day. Looking at the historical trailing 12-month revenue, it's no wonder why so many people are so enthusiastic about owning Visa. Hell, I even own a small sliver of this stock. Friends of the channel like Ryan Dengler and the Dividend Dude also seem to really like Visa. And as a matter of fact, I hold it in my YouTube portfolio where my viewers voted that I buy Visa. So what you have here is such a consistent pattern of growth in their revenue, with one minor exception being an understandable pullback during the pandemic, where large sections of the world economy were literally just shut down for a period of time. But like with many other great businesses and the market as a whole, very often the recovery is far stronger than any pullback. And this has definitely been the case with Visa in terms of their revenue growth. So it should come as no surprise that Visa enjoys a wide economic moat and strong growth. I don't think the moat requires that much explanation. Open up your wallet right now, or your purse, or whatever, and I'm going to bet that there is at least one plastic card in there that reads Visa in the corner of it. That is going to be true for probably 99% of people listening to this right now. So that is basically the definition of a moat. Imagine trying to start a business and how much it would cost for you starting a new payment processing business to take market share from Visa. That would be really difficult unless the name of your company was MasterCard. So when it comes to Visa, they are so ingrained in the modern economy that's moving more and more paperless that they're super well positioned to continue having growth and maintaining their extremely high market share. I also want to take a moment to appreciate just how profitable Visa is. So this is net. This is their net profit margin. That means almost 53 cents out of every dollar of revenue that comes in is pure profit. All overhead done. Their free cash flow margin is even higher at a high 50s, low 60s, with gross margins 80% or better in recent history. This means that they can take over 50 cents of every dollar and put it back into rewarding shareholders and creating shareholder value. That is incredible. When you factor that in with their high growth, it's no wonder why people are so enthusiastic about this company. These high margins offer the wiggle room that the company needs. For example, a temporary drop in revenue, a temporary increase in expenses, or some kind of a one-time cost really is just a blip to a company with this much meat on the bone to work with. Comparing that to a lower margin business like Walmart that has 2% net margins, it really doesn't give them much room to work with, much margin for error. But Visa, on the other hand, even though I would say there are very few errors being made, they do have a pretty big margin of safety to work with within their own business. Speaking of rewarding shareholders, one of the ways they can do that is through share repurchases. As you can see, the shares outstanding have been steadily declining for years. And you might be saying, hey, wouldn't we rather them do it when the stock is cheap? Well, to be honest, the stock is rarely what a value investor would consider to be cheap. And this is just one of the more tax-efficient ways for them to reward shareholders directly. A business like Visa benefits from basically the steady increase in economic activity, and there are only limited ways they can reinvest for more growth. They do, of course, also pay out a dividend, though it is a pretty low yield today. It has a low payout ratio. They're only paying out about a quarter of their earnings in dividends currently, and the growth is pretty impressive. If you combine that with the rate at which the business is growing their cash flow and the rate at which they're buying back shares, I think over time you could see your yield on cost become pretty respectable, and over decades there would certainly be a pretty nice compounding effect that would occur. However, that's the long game. Right now, 0.8% isn't exactly paying the bills or anything, but it is and could be the start of the old dividend snowball that so many investors are so fond of. Additionally, according to this infographic I found in an article on Wallet Hub, Visa currently has 52.6% of credit card market share by purchase volume. Now, this is one of those interesting cases where I actually like all four of the companies listed here and have at least a small position in each of them in one way or another, though by far I have more of Visa than the other three. Discover was even a candidate for my value portfolio recently, but I digress. Visa has more than 50% market share by credit card purchase volume. Let that sink in. That just speaks to the depth and width of their economic moat. It truly is seemingly insurmountable at this point. So, some of you might be noticing that my valuation model here on Visa doesn't look very similar to a lot of other companies. You'll see that I've only got the default 10% discount rate in there. Now, this is because I want to explain why it is Visa is trading hands at a premium and why that's normal for a forever business to do, for a forever stock. So, you've got this high degree of business predictability. That means, generally speaking, you can count on the fundamentals to improve at about the rate that they're expected to improve at, okay? You don't generally have a lot of wild volatility and swings with how the business itself performs, and that's important because what that means is that investors then feel safe anticipating future expectations to come true and applying their valuation based on those expectations. What do I mean? Well, take today's valuation. About 260 is where it's trading hands for. All right, that's what the general market seems to think it's worth right now. Well, if you take the projected earnings per share for 2026 of $13, apply the market discount rate, and what I think is probably a pretty reasonable growth rate from there for Visa. They've actually done better than this the last 10 years, so this would imply some degree of slowdown, actually, with it falling further into the mid to high-ish single digits after that. Again, pretty reasonable, probably, about where, the average market participant might anticipate if they even bother to do this kind of work. And you come up with a fair value of about $253, and maybe, say, hey, it's not too much more than that. You get a number of people putting in their orders, as long as it's pretty close to that price, not being too terribly picky. And, being okay with a little bit of a premium because of the fact it does have a wide moat. It is very predictable. And in the grand scheme of things, $5 or $6 per share difference on Visa is probably not going to be the thing that makes or breaks them, especially if you're holding it forever, for 30 or 40 years, whatever your time horizon might be. So that's where I think the market is putting it and why. This definitely, I don't think qualifies as a quote-unquote value stock, but there is definitely a reason why people love this stock, and why, if your time horizon is long enough, it could be worth a serious look. And I do have, one share right now of Visa, and I'm not necessarily jumping with joy to add again, but it is certainly one of those things where, hey, on a pullback, I might give a little bit more consideration and leeway on valuation than to some other lesser businesses out there. That's about all for this for now, ladies and gentlemen. That's been Visa stock. Visa, a forever stock. Take it easy. Thank you for making it to the end of the video. Here are all my plugs. Follow me on Twitter, X, whatever you want to call it, at Mr. Macho Mog. Like the video if you liked it. Subscribe to the channel if you want me to be your forever finance influencer. Hit the notification bell to never miss another video. And hop on Discord, link in the description. Also catch me Saturday, 8 p.m., Cashflow Kings Live. Take it easy, everyone.